Imagine waking up one morning to see the world's most influential tech leader issuing a warning about Bitcoin, not some anonymous analyst, but Mark Zuckerberg himself. That's right. When someone with unparalleled access to global user behavior, financial data, and market trends openly raises red flags, it's impossible to ignore. And today, that warning isn't just a passing headline. It's a signal that every investor, trader, and crypto enthusiast needs to pause and think carefully about their next move. The world of cryptocurrency has always been a delicate balance of fear and greed. On one side, the promise of life-changing gains entices millions. On the other, the very real risk of catastrophic losses looms silently. It's a landscape where emotions often override logic, and history repeatedly shows that those caught in the excitement rarely emerge unscathed. Zuckerberg's statement isn't just a soundbite. It's a wake-up call to examine the assumptions we make, the risks we choose to take, and the psychology that drives our financial decisions. Could the next crash be closer than we think? And if it is, will you be prepared or will you be swept away by the tide? Consider this: the same human impulses that fuel the rise of Bitcoin, herd behavior, fear of missing out, and the greed for quick profits, are the very forces that can accelerate its collapse. This isn't fear-mongering, it's a moment to reflect. Because when the warning comes from someone like Zuckerberg, it's not just about Bitcoin. It's about understanding risk, timing, and the reality that the stakes have never been higher. Why do investors often ignore risk, even when warning signs are flashing red? The answer lies deep in human psychology, a potent mix of fear and greed. Bitcoin, more than any other asset, exposes these impulses. The lure of rapid, life-changing profits can make even the most cautious person act irrationally. Every day, social media feeds and news headlines reinforce this behavior. Stories of people turning small investments into millions flood our screens, creating a compelling narrative: get in now or miss out forever. This is FOMO, fear of missing out, amplified by networks of friends, influencers, and even institutional endorsements. Greed doesn't just push people to buy, it makes them blind to the underlying risks. Investors convince themselves that this time is different. They ignore fundamental principles, dismiss warning signs, and assume the momentum will continue indefinitely. Mark Zuckerberg's warning isn't just advice, it's a reality check. Even those with extraordinary insight and access to global data recognize that Bitcoin's volatility could lead to catastrophic losses. Yet the emotional pull of potential gain is often stronger than reason. History offers sobering lessons. During the dot-com bubble of the late 1990s, investors poured billions into internet startups, many of which had no real revenue or business model. When the bubble burst, countless fortunes evaporated almost overnight. Long before that, in the 1630s, the tulip mania in Holland drove single tulip bulbs to prices higher than houses. People traded farms, businesses, even entire estates for the hope of one more rare bulb. And when the mania ended, those same assets became worthless. Repetition is key here. When everyone says this time is different, that's the moment when it's the most dangerous. Today, Bitcoin mirrors these historical patterns. Hype spreads faster than ever thanks to social media, celebrity endorsements, and institutional attention. The more people hear success stories, the more they ignore the probability of failure. But psychology hasn't changed. Human behavior repeats itself. The factors that drive a market to dizzying heights, rapid adoption, widespread excitement, and herd mentality, are the same forces that can trigger an equally dramatic collapse. Understanding this doesn't mean you must avoid Bitcoin entirely. Instead, it's about perspective and awareness. Recognize the traps of FOMO and greed, weigh potential rewards against the very real possibility of loss, and remember that rational investing often means resisting the crowd. History favors those who act with reason, not reaction. The moment everyone screams, "This time is different," that's precisely when caution should dominate. As we continue, we'll dig deeper into Zuckerberg's warning, examining the data and signals that suggest a major market shift could be imminent. By understanding both psychology and facts, you'll be better equipped to protect your wealth, and perhaps even seize opportunities that others overlook in the chaos of emotion-driven investing. Mark Zuckerberg's warning about Bitcoin isn't coming from a casual opinion or offhand remark. It's rooted in deep observation, analysis, and access to data few outside Meta ever see. Within Meta, user behavior and internal trends reveal patterns that most investors ignore. The way billions interact with technology, apps, and online assets offers subtle but powerful signals about market sentiment. Small shifts in engagement, transaction behavior, or even discussions in social networks can indicate larger trends in speculative investments. Institutional adoption adds another layer of complexity. On one hand, large companies entering the Bitcoin space lend credibility and fuel optimism. On the other hand, this creates a dangerous imbalance between retail enthusiasm and institutional influence. When everyday investors see mega funds, hedge funds, and corporate treasuries allocating billions into Bitcoin, the perception of safety can overshadow the underlying risk. The result: retail investors are often lured into overexposure, chasing upward potential while underestimating downward risk. Zuckerberg's concern isn't hypothetical. He's monitoring liquidity signals, whale movements, and overexposure indicators that suggest the market is precariously balanced. Large holders, the so-called whales, can move the market with a single trade. When combined with retail FOMO, the stage is set for extreme volatility. In essence, the same forces that propel Bitcoin to record highs can just as easily trigger sharp, sudden crashes. To make this more tangible, consider a few illustrative examples. In 2021, a handful of whales coordinated large-scale Bitcoin trades during a period of intense retail speculation. Prices spiked and then plummeted within days, leaving latecomers scrambling. Meta's internal data shows that discussions about digital assets on social platforms often precede massive buying surges, and then panic selling follows shortly after. These patterns are not isolated, they're consistent across time and cycles. Zuckerberg's warning carries credibility because it's based on direct access to behavioral signals, not just market charts or headlines. When someone with unparalleled insight into global digital trends cautions about overexposure and potential crashes, ignoring it isn't just risky, it's potentially catastrophic. But there's more. Institutions entering the market create a feedback loop. Positive sentiment drives more retail investment, which increases liquidity temporarily. However, when institutions take profits or shift strategy, liquidity dries up and volatility spikes. That's why Zuckerberg emphasizes caution. He's not predicting doom for Bitcoin. He's signaling that conditions are ripe for a major shakeout. What should investors take from this? First, understand that market psychology and technical signals matter just as much as blockchain fundamentals. Second, recognize the asymmetry of risk. The upside may look attractive, but the downside, sudden crashes, loss of capital, and emotional stress can be far greater than most realize. Finally, diversify and stay vigilant. Opportunities exist, but only if you combine insight, patience, and rational analysis. Zuckerberg's message is clear: don't let hype, institutional pressure, or social media frenzy dictate your financial decisions. Observe the data, respect the risk, and think several steps ahead. Markets can reward boldness, but they punish ignorance. The coming weeks and months may present both danger and opportunity, but only for those who remain alert, informed, and disciplined. Bitcoin. The word alone sparks visions of explosive gains and financial freedom. Scarcity, network effects, and ETFs have created a perception that Bitcoin is almost safe, a digital gold that can only go up. But as we'll see, this sense of security is largely an illusion, and understanding it is crucial before you risk your capital. Let's start with scarcity. Bitcoin's supply is capped at 21 million coins. This limited supply is often cited as a primary reason for its long-term upside. The logic is simple. Fewer coins combined with growing demand equals higher prices. Then comes the network effect. Bitcoin isn't just a coin, it's a decentralized network of users, miners, and investors. The more participants, the stronger the system becomes, and the harder it is for alternative cryptocurrencies to displace it. On paper, these factors suggest stability, even growth. ETFs and institutional adoption reinforce this illusion. Seeing companies like BlackRock or Fidelity investing in Bitcoin provides a psychological safety net for retail investors. Social media amplifies this effect, fueling hype and creating a belief that if the pros are in, it must be safe. But here's where greed and rational risk collide. Upside exists undeniably. Bitcoin has delivered life-changing returns for early investors and savvy traders. But this upside is heavily skewed. For every winner, there are countless retail investors exposed to volatile swings and market manipulation. Greed-driven behavior often masks the reality. Bitcoin can rise dramatically, but it can also fall precipitously. Think about the lessons from history. Bubbles form when rational risk assessment is replaced by mass greed. During the dot-com bubble, people believed this time is different. Tulip mania taught the same. Bitcoin today shares similar behavioral traits. As the saying goes, upside is real, but only for a few, risk for many. Let's illustrate this practically. Institutional investors control a significant portion of Bitcoin's liquidity. They can influence prices with large trades, while retail investors, driven by FOMO, often buy near peaks. When these whales move, market swings can be swift and unforgiving. Understanding this asymmetry is key. While the technology and potential are real, the probability of significant losses for the majority is equally real. The takeaway is clear. Bitcoin's scarcity and network strength provide real opportunity, but it is not a free pass to safety. Greed entices, fear warns, and only those who understand the balance between upward potential and downward risk will navigate this market successfully. When we talk about Bitcoin's upside, it's easy to get swept up in the hype. But the other side of the coin, the potential for a crash, is where real danger lies. Understanding how a crash happens is crucial for anyone invested or even considering entering this volatile market. Let's start with the mechanics. A crash often begins quietly, triggered by a liquidity crunch. Liquidity, in simple terms, is the ease with which assets can be bought or sold without causing drastic price changes. When liquidity dries up due to large investors or whales moving out of positions, the market can spiral. Prices begin to fall, triggering automated stop-loss orders, margin calls, and forced liquidations. This creates a feedback loop, accelerating the decline. Leverage amplifies this effect. Many investors borrow funds to increase exposure, aiming for higher returns. But when the market turns, these positions can be liquidated instantly, adding fuel to the fire. Panic selling follows naturally. Investors, driven by fear, rush to exit, often at significant losses. Social media and news cycles intensify this fear, creating a domino effect that impacts everyone. History offers sobering lessons. The 2017 Bitcoin bubble saw prices surge nearly 20-fold, only to collapse by over 80% in less than a year. 2021 repeated the pattern, with institutional and retail investors both caught off guard. Even further back, the dot-com crash and tulip mania show that speculation-driven markets share the same fate: euphoric rises followed by brutal corrections. Here's the truth: predicting the exact timing of a crash is impossible. As the old saying goes, when will the crash come? I don't know, but the impact will be felt by everyone. The uncertainty is part of the danger. Even seasoned investors can be blindsided, which is why understanding risk exposure, position sizing, and liquidity management is critical. From a psychological perspective, this is where fear and greed collide. Greed pushes investors to chase gains, often ignoring red flags. Fear emerges when the first signs of decline appear, prompting irrational decisions. Recognizing these emotions in yourself and others can prevent catastrophic losses. Practical advice is simple, but often ignored. Diversify your investments. Avoid excessive leverage. Keep an eye on liquidity signals and the concentration of holdings among whales. Most importantly, prepare mentally. A crash doesn't just wipe out money, it tests emotional resilience. When we talk about Bitcoin and its volatility, it's critical to ask, what are the alternatives? What could you be doing with your money if it isn't tied up in a highly speculative asset? Understanding this is not just about diversification, it's about opportunity cost, the hidden price you pay when chasing high-risk gains. Let's begin with cash flow generating assets. Real estate rental properties, for example, provide consistent income over time. Unlike Bitcoin, whose price can swing wildly in minutes, rental income is steady, tangible, and in many cases predictable. Investors can forecast returns, plan budgets, and reinvest earnings, creating a compounding effect that builds long-term wealth. Then we have index funds. These allow you to invest in a broad range of equities, capturing the general growth of the market while spreading risk. Unlike Bitcoin, which can be influenced by a single news event or whale movement, index funds offer stability and historically positive returns over decades. They may not provide the thrill of a 10x gain overnight, but they consistently outperform speculative bets in the long term. Dividend-paying stocks are another avenue. Companies with solid fundamentals distribute a portion of their profits to shareholders, providing both cash flow and potential capital appreciation. Even in a down market, dividends can cushion losses. The lesson here is simple. Productive assets generate real value rather than relying on market hype or speculation. Here's where opportunity cost comes into play. When you put money into Bitcoin during a speculative frenzy, you're not just risking potential loss, you're simultaneously missing out on these stable, wealth-generating options. As the saying goes, the money that went into risky Bitcoin, you are missing out on stable growth. This isn't fear-mongering, it's a sober evaluation of choices and trade-offs. Understanding alternative investments also helps you maintain perspective when markets crash. If your portfolio is diversified with productive assets, a Bitcoin crash won't wipe you out. Instead, you can ride out volatility, potentially even using market dips as opportunities to rebalance intelligently. In short, opportunity cost is the silent danger. It's not just what you could lose, it's what you forego by chasing outsized gains in risky assets. By examining alternatives carefully, you give yourself a margin of safety, a strategic advantage, and peace of mind. Before we wrap up, I want to pause for a moment and ask you a very simple but critical question. If you had to hold Bitcoin for the next 10 years and could not sell, would you buy it today? Think about it carefully. This isn't hypothetical, it's a mental exercise designed to reveal the true nature of your investment instincts. At first glance, the answer may seem obvious. After all, Bitcoin has skyrocketed in the past, and the stories of early adopters turning small investments into life-changing fortunes are everywhere. That's the greed talking, the seductive pull of potential upside. It's hard to ignore the allure of a 10x or even 100x return, especially when the media, social networks, and investment forums reinforce the narrative that this time is different. But now, let's switch to fear. Imagine the opposite scenario. A prolonged bear market, a global regulatory crackdown, or a sudden crash triggered by leveraged positions and liquidity crunches. Unlike other productive investments, Bitcoin has no intrinsic cash flow, no dividends, and no guaranteed returns. Your entire capital is exposed to volatility, extreme ups and devastating downs. The psychological weight of watching your net worth swing by tens of thousands in days or even hours is enormous. This thought exercise forces you to confront the tension between greed and rational risk. If you find yourself excited at the potential upside but uneasy about the possible downside, that's exactly the signal you should heed. Investing is not about chasing headlines or social media hype. It's about balancing reward with risk. Now, consider opportunity cost. Every rupee tied up in a high-risk asset like Bitcoin is money you are not putting into productive, wealth-generating options. Dividend-paying stocks, index funds, or cash-flowing assets like real estate. These alternatives may not promise astronomical returns, but they compound over time, providing stability, predictability, and peace of mind. Ask yourself, what could I be missing if my entire focus is on speculation? Here's where repetition matters. Think again, if you had to hold Bitcoin for 10 years, would you buy today? Repeat this question internally. The answer often reveals the truth about your risk appetite and investment strategy. High potential reward comes at a cost, and that cost is not just financial, it's emotional, strategic, and long-term. Finally, let's bring it back to the bigger picture. The market is cyclical. Crashes and booms are inevitable. Knowing this, your decisions today shape how you weather future downturns. By honestly reflecting on your choices, you can avoid panic selling, regret, and financial mistakes. The exercise is simple but profound. Think critically, assess risk and reward, and always consider opportunity cost. So take a moment, pause the video if you need to. Ask yourself, am I investing for potential greed, or am I making a rational decision based on risk, alternatives, and long-term value? Your future self will thank you for the clarity and discipline you apply today. As we reach the conclusion of this discussion, let's step back and reflect on what Mark Zuckerberg's warning truly means. Zuckerberg isn't just commenting on price fluctuations. He is highlighting broader patterns in human behavior, market psychology, and the fragility of speculative bubbles. When someone with access to the world's largest data sets, observing both retail and institutional behavior, flags potential danger, it's a signal worth serious attention. The key takeaway here is clear: smart investing beats speculation. Speculation tempts us with the promise of extraordinary gains, but it comes paired with extraordinary risk. Fear and greed drive decisions in moments like this: fear of missing out when prices rise and fear of loss when markets wobble. Greed can cloud judgment, while panic can destroy value. The lesson is not to ignore opportunity, but to approach it with discipline, strategy, and awareness of both potential upside and inevitable risk. Consider the contrast: a carefully diversified portfolio of productive assets, cash-flowing stocks, index funds, or real estate offers growth over time with stability. Bitcoin and other high-volatility assets might surge, but only for a fraction of investors who time the market perfectly. For everyone else, the downside can be catastrophic. Repeat this to yourself: upside exists, but risk is real, and your decisions today define your tomorrow. Now think of the broader implications. Markets are cyclical. Liquidity crises, leveraged positions, or sudden regulatory shifts can trigger sharp downturns. Crashes may or may not happen tomorrow, next month, or next year, but they are always possible. By recognizing this, you prepare yourself mentally and financially. You shift from reactive panic to proactive planning. That is the true edge in investing. Let's return to opportunity cost. Every rupee spent chasing speculative gains is money not earning steady growth elsewhere. Ask yourself, what are you sacrificing in pursuit of potential meteoric returns? This is not fear-mongering, it is insightful analysis grounded in reality. Opportunity cost is real, and understanding it allows you to make rational long-term decisions. Finally, as we close, remember this simple but powerful reminder: a crash may happen, or it may not, but you need to be prepared. It's calm yet authoritative. It acknowledges uncertainty while emphasizing preparedness. That's the balance every serious investor must strike: curiosity without recklessness, ambition without blind greed, and caution without paralysis. So take a moment to reflect, review your portfolio, evaluate your risk exposure, and ask yourself whether your strategy aligns with your long-term goals. Use this pause to decide whether you are chasing hype or investing with foresight. Your financial future depends not on luck, but on disciplined choices, informed thinking, and the courage to act wisely. This is the ultimate insight from today's discussion. Markets will always present both danger and opportunity. The question is simple: are you prepared to navigate them with intelligence, strategy, and clarity? Think about it, and let your decisions be guided by insight, not impulse.